All right, so thank you for coming. This is Nashi from Trade Genie. Today we will cover a small topic called options expiration cycle. Um, it's important as an option trader, it's important that we know what is option expiration cycles and what are different kinds of options, such as weekly, monthly, quarterly, and why they exist, and the importance of understanding the options expiration cycle. So today we will learn about what is option expiration, what is option expiration cycle, why we need to know option expiration cycle, three types of options, three types of option expiration cycles, and how the stocks are assigned to these cycle. So each stock, when they go public and when the options start trading, then they are assigned to one of the cycle. And then there is something called what is modified options expiration cycle. So there is a reason why they introduce modified option expiration cycle. So we will go over the examples of option expiration cycles, such as when the current month is it's expiring. For instance, the March expired this Friday. Then what happened? So what happened after the expiration date? And then understanding option cycle for leaps. So leaps behave differently. So we'll go over each of this topic. No sound. Do you guys hear? You don't guys hear the sound or no? So somebody's saying no sound. Let me. Um, okay. Yeah, thank you. So if you don't hear my sound, something in your side because I'm speaking, the sound is okay. Okay. So what is option expiration? Options have expiry date. So we know options have expiry date, and options such as third Friday or every Friday or the last trading day of the month. So there are three different kinds of option expiry date. And then there are three, each stock is assigned to expiry cycle. So what are those cycles? So options have expiry date. They are weekly option, monthly option, quarterly options, and then there are three expiry cycle, which are January, February, and March. So there are three kinds of cycles. Yes, so I'm speaking through computer. Okay, so why we need to know option expiration cycles? Because when we trading options, it requires a strategy. So if we understand what are the different kinds of option expiration cycle, it helps us in adopting the proper strategies. We may need to adjust our trade. So knowing which expiration cycle this stock belongs to and what would be the next month they will open after this it's coming up the expiry month. Let's say we are in March and we are in the trade and the current month is March, then we know it helps us to know which month they will open. So in the change, you will suddenly see a new month is added. So how that is added. So if we know the option expiration cycle, it increases our success rate. So we can figure it out what should be our next step. So we're not trading in the dark, and it's not good for the portfolio. Sometimes we have to roll over our option trade. So knowing when we can roll over, what month we can roll over, how many times, how many days we can buy, what is available after this month expiry, it helps in our success rate. So knowing option expiration cycle is important. So now there are three types of options. So we know weekly options, monthly options, and then quarterly options. So each option have a purpose and have an expiration cycle and the purpose. So I'll go briefly over these weekly options, monthly and quarterly, and you can always Google on these topics and learn, um, uh, on your own. So okay, so if you have a problem so you have to adjust your go-to. This is the go-to webinar, so you have to adjust your volume and audio setting on your side. So just adjust your side. Weekly. So what is weekly option expiry? So weekly options. So weekly options are listed on Thursday and expires next Friday. So uh, let's say Apple. So new weekly options will started trading last Thursday, and then they will expire this coming Friday. Initially, they were they did like starting to trade on Friday and then expires Friday. But now they open up on Thursday and expires next Friday. And the reason for 1 day opening is so then you can roll over your trade. If you have to roll the trades to the next, then you can do so. So if you have a trade open uh, and you like to keep it open for next week, then you can open your trade on Thursday and close the one on Friday, the one which took next day. So 1 day before and then 1 week later, the Friday. So why they introduce weekly options is it's designed to for investors and speculators to trade around news and events. So you may not want to buy extra time by buying the monthly or quarterly option. So you're just trading the news. So when you are trading the news, you expect something dramatic to happen, and you just need to be in the trade 3 to 4 days. So when you are you have a need to trade only 3 or 4 days, you just want a weekly option. And there are certain stocks which you can study like big names and create a basket. So you can trade a basket of stocks like Apple, Baba, those who have weekly options. You can buy options on Thursday and close it on as a basket on Wednesday or Thursday. So whatever target you have. So let's say you open 10 trades weekly options and 10 trade the ones which are you expect to move. So you open on Thursday or you open on Friday. So you open on Thursday or Friday, and your objective is that whenever the basket of your trade reaches a certain profit level, you close the whole basket. So you can try out this strategy. Another the reason people buy weekly option is earnings trade or hedging the portfolio. So they expect some dramatic news may come out and it can um, it can affect your portfolio. So when that happens, you're buying. You don't want to. So you expect this news will come out only in this week, and it will affect your portfolio. So you hedge your portfolio by buying, let's say, puts, and you only need few days, so you don't want to pay extra. So you're just buying an insurance, like like an insurance you buy sometime at the airport, travel insurance. So it's like that. So you can do that. Now, some options are AM settled and some are called PM settled. So what are the AM settled and PM settled? So you need to know is it AM settled or PM settled? So PM settled. So PM settled options are for equities and ETFs. So equities and ETFs and exercise. So you can exercise your option, or the options can be or the stock can be assigned to you. You can exercise your right, or you can get assigned. Someone else exercise his right and then you get assigned. So exercise and assignment are determined after the close on Friday. So options expire on Friday, let's say on a weekly option expiring on Friday, but you can get assigned next day, like on Saturday. So everything is Saturday morning. So everything is determined after the close on Friday. So that is called PM settled. Now the AM settled are index option. So the last day for AM settled options, the day before expiration. So the options are expiring Friday, they get exercised on Thursday. So on Friday morning, you can exercise or get assigned. So AM settled and PM settled. So so you understand this formula, AM settle and PM settle. Now, monthly options. So most of us, we trade monthly options. At least I trade monthly options. So monthly options, last trading day of third week. So whatever is the last trading day of the third week, that's where the options expire. So most of the time, the last trading day of the third week is Friday. But if Friday tends is if the market is closed, let's say a long weekend or whatever is the reason the market is closed on Friday, then the options can expire or will expire on Thursday because that's the last trading day of the week, last trading day of the third week. So third week, so either Friday or Thursday. Now, legally options expire on Saturday, but because the trading stops on Friday and then the exercise and assignment happen on Saturday morning. So remember the monthly option expiry. Now, the last one is a quarterly option expiry. So quarterly options, so there are 4 quarters in the year. So quarterly options, last trading day of every quarter. So these options expire last trading day of every quarter. So March, June, September, and December. These quarterly options are designed for big boys so they can rebalance their portfolio. So they have huge positions. So they hedge their portfolio. They have to go long on a certain options. They do the rebalancing every on the last day of each quarter. So so this is the reason this kind of a option is created, quarterly options, and it's available only on major indices like Dow Jones, DIA, SPY, IWM. So there's a missing M here. IWM, QQQ, XLE, GLD. So quarterly options are designed for indices. And the reason is to rebalance for the big boys to rebalance their portfolio on the last day of the quarter. So you would see in the quarterly options, you may see large contract sizes. You may see the spread is wide. So it's not like activity going on like you see in the weekly options or monthly options. So, but knowing that there are indices where the quarterly options are available. So knowing you don't have to do everything, but knowing is good. So just in case so we tend to make mistakes. So in trading, we make mistakes and it costs money. So if we eliminate our mistakes, it directly helps in our portfolio. So one of the mistakes we can do is in a hurry, like trading options, in a hurry, instead of buying calls, buy puts. On the wrong side, push the button. Instead of buying one contract, push the button for 10. There's a big problem there. Instead of buying monthly option, bought the weekly and then wonder why my option is expiring, decreasing in value so much, why the spread is huge. So looking at the quarterly option, or maybe there's another thing, a non-standard options when the dividend etc. are announced. So we see some weird strike prices, and then we wonder why we see these weird strike prices. They don't make sense because the strikes are generally in an increment of like $2.50, $2.50, $5, etc. And then sometimes we see like strike of 46.46. So it's because something happened to that stock, and that so these are non-standard options, and after the expiry you won't be able to see it. So being aware of all that, it helps. So I'll cover the topic of non-standard and stock dividend and cash dividend in some future and how it affects the option in some other webinar. So now, what is option expiry? This is the topic of today's session. What is option expiration cycles? So expiration dates that apply. So these option expiration cycles are the expiration dates that apply to different series of options. So different series of options, the expiration dates are being applied. So I will explain to you by example. There are 3 option expiry cycles: January cycle, February cycle, and the March cycle. And these cycles are applied to stock and index options. So I'll explain now. So if you look at the option chain, you will notice that each option has 4 expiration months. Each option has 4 expiration months. So the current month, so now the March is gone. So the current month is for the standard month, monthly option, the month is April. And then they add subsequent month. So April is the current month, then the subsequent month is May. And then on top of that, they add 2 extra months. So there is a current month, then there is a subsequent month, and then they add 2 extra months. So each option you would see at least 4 months listed there for monthly options. So current month, subsequent month, and 2 extra months. So sometimes the traders, they make this mistake also. The setting is wrong. They don't see the proper interval. They don't see beyond. When you open an option chain, if the stock is trading at 50, by default they will show you 47, 50 strike, 45 strike, 52, 50 strike, and 55 strike. So we need to expand the cycle so we can see where else the volume is or where else the spread is. So you can see beyond, and then not only you see the current month, not only you can see you're seeing the current month or the subsequent month, but you are seeing more than that. So you have to expand. So when I send the trade, let's say we are in April, and I send the trade for July, and then I receive email saying, no, I don't see any July option. So the setting is wrong. So just expand your option chain. So now current month, subsequent month, and 2 extra months. So which 2 months, right? So we know the current month, April, subsequent is May, and then they add 2 extra months. So these 2 extra months, which 2 extra months? Which 2 extra months? So which 2 extra months? There are 12 months in a year. Let me please, we're having a problem. They are logged in via audio. Let me see. Okay, I'm sending another email. Sorry, people have some problems. So there are 12 months in a year. So which 2 months? There are 12 months in a year. So how we figured out these 2 extra months. So understanding the option expiration cycle will help you answer this question, which 2 extra months. So the 3 option expiration cycle: January cycle, February cycle, and March cycle. So expirations, now when the stock start trading options, they randomly assign somebody assign a stock randomly on the basis of, or maybe they have some logic, but I read that they can get assigned randomly to stock cycle A, January cycle, February cycle, and March cycle. So if there are 3 stocks come IPO and they start trading options, one can get assigned to January cycle, another one to February, and the third one can be assigned to the March cycle. So January cycle, February cycle, and March cycle. So what is January expiration cycle? So they do like this: January cycle. So January first is the first month of the year. So January is the first month of the year. So this stock will have January as the first month of the year, and then the first month it will also trade April, July, and October. So April, first month of the second quarter, July is the first month of the third quarter, and October is the first month of the fourth quarter. So there are 4 quarters. If the stock is assigned to a January cycle, it will have these 4 months: January, April, July, and October. Similarly, for February expiration cycle, The February is the second month of the year, right? So February is the second month of the year. So the second month of the second quarter is May. The second month of the third quarter is August. And the second month of the fourth quarter is November. So the stocks which are assigned to February cycle, they will have these months as an option expiration cycle, as an option expiry. So second month, February. The third month, March expiration cycle. So since March is the third month of the year, so it will have the stock which is assigned to March expiration cycle. It will have these months: March, June, third month of the second quarter, September, the third month of the third quarter, and December, the third month of the fourth quarter. So anytime the chain will display at least 4 months. So those 4 months are these: the current month, the subsequent month. So whatever is the month next month. So they call it modified month, the subsequent month, and then they add 2 months. So these 2 extra months come based on the cycle. So if January is the expiration cycle, January is the first month, then it will have April and July. So if it's the current month is January, it will have January. The subsequent month becomes February. So the option chain will display January and February and the next 2 months. So the next 2 months will be April and July. So January, February, April, and July. For February expiration cycle, so February is the second month of the year. So if February is the current month, then they will have, this stock will also have March expiration cycle. So March expiration also. So February and March, and because the February, because this stock is assigned to a February cycle, so it will have May and August also listed. Now, if let's say if the stock is assigned to March expiration cycle, and let's say the current month is March, so March and April and June and September, March and April and June and September. So we will go into detail when we go beyond the March. So what happens? So there's another concept, the modified, they call it modified option expiration cycle. Previously, when the option was trading, they were just having this current month and then 2 extra months. So they had current month and 2 extra months. So now, if you have only current month and then don't have a subsequent month, then they were having, the traders and the speculators, they were having problem in rolling over their options to next month, or buying extra time. They didn't want to buy the current month, but then if there are 2 extra months, they have to go beyond, so they have to buy extra time. So for all these reasons, they introduce the subsequent month, and they call it a modified option expiration cycle. So the current month, so now the current month right now is April, starting Monday is April, the current month. The March is gone, and then you will see May also. So April and May, and then the 2 extra months you will see depend on the option expiration cycle of that stock. So modified option expiration cycle is current month, subsequent month. So why modified option expiration cycle? Because of the speculation and hedging. So they introduce an extra month close to. So if let's say this is the last week of March, the third week of March, and if you don't have April option, then we are having a problem. Maybe we have March and then June and September, something like that. And if we don't have April, then we have a hard time in rolling, because we just want to roll to the next month. So for speculation and hedging, they added subsequent month. So now let me explain you how the option expiration cycle works. So after explaining all that, so how option expiration cycle works. So let's say today's date is January 1st. So today's date is January 1st, and option expiration cycle. So this is stock, whatever the stock is, ABC, XYZ, it is assigned to January cycle. So it is assigned to January cycle. Now we know that available month, at least there should be 4 available months. So if the January is the current month, let's say January 1st or 2nd is today is January or January 2nd or 3rd or 4th, then January is the current month, and we know February is the subsequent month. So you will see this stock trading in January option and February options. But because, so we need 2 more months. So because this stock is assigned to a January cycle, and January is the first month of the quarter, it will have the first month of the next quarter, second quarter, and the first month of the third quarter. So in other words, you will see January, February, and April and July options displayed. So January, February, and April, July. So April and July is coming from the option expiration cycle itself. So April and July coming from option expiration cycles. January, and because the current month itself is January, so we will see January option, and we will also see February because it's the subsequent month. So option expiration cycle gave you one example. Another example, what happened when January expires? So third Friday of January comes and go. So now we don't see January. So we will see February as the current month, right? So no January. But then based on the formula, so the formula is the current month plus subsequent month plus 2 extra months. So that's the formula, current month plus subsequent month plus 2 months. So the current month is February. So we know that. So we need the subsequent month. So for the subsequent month, we will see March. So February, current month, March, we will see subsequent month added. So automatically when the January expires, you will, and then you come next week after the expiry, you will see, oh, March is there. So knowing that March is coming, you can take some action before. And then we need two extra months. So because this stock was assigned to a January cycle, so and January is the first month of the quarter, so we will get the first month of the second quarter and the first month of the third quarter. So now after the expiry, January expires, we will see February, March, April, and July. So January, March, April, and July. These were the months you will see. What happened when January expired? February, March, so this is newly added, April, July. So now what happened when February expired? So when February expires, we know we need to have at least 4 months, and the stock is belong to January cycle, so available months are 4. So when the February expires, March becomes the current month, April becomes the subsequent month. So here, look at this one. So here we have March, April, and July, right? March, April, and July. Now this month expires. So when February expires, we already have March, April, and July, but we need another month below July, another month below July. February expired. We have March, April, July, and we need another month. So which month is added after the July? So October will come. After July, October will come, because the March will become current month because February expires. April is the subsequent month, which is already there. July is the first month of the third quarter, which is already there. Now we need another first month of the fourth quarter. So October will be added when the February expires, and if the option belongs to January cycle. So when the option belongs to January cycle, February expires, we already have March, April, and July. So we already have March, April, and July. February expires. When February expires, we add another 1 month called October, and it's newly added. So now you will see March, April, July, and October, and so on. So option now, so that was for the standard option, or the monthly options. Weekly option, they expire every Friday. So now the option expiration cycle for leaves for the long-term options, those who expire more 1 year, 2 year, 3 year down the road. So So what is LEAP? LEAP stands for long-term equity, anticipation, participation, security, the long-term. Just, in short form, long-term option. And not all stocks have LEAPs, so only the most popular. They have more than 4 expiration months, so they have more than 4 expiration months, 1 year, 2 year down the road. No more than 3 years out. So this is what I know, that you won't find more than 3 years. So 3 years enough. Usually trade with January month option expiration. So they start with January option. And leaves months are added in May, June, or July. So they add new months in May, June, and July. And this is how it works. So I will give you the example, which I just created, modified. So let's say option expiration cycle, this is stock, is assigned to January cycle. And January is the first month of the quarter. Let's say the current date is May 2021. So the month is May. So if we have May of this year, so now we need at least 4. For standard option, we need 4. Plus for lead is 1 year extra, 2 years extra. So think about this. So May is the current month. So the formula is current month plus subsequent month plus 2 months. So that is the formula for standard option. For the lead, if you look at this, the formula is like, okay, the current month plus the subsequent month plus 2 months, then the coming January, and then another January. So current month is May, subsequent is June. So current month plus subsequent month. So May is the current month, subsequent month is June, and then we need 2 more months, 2 extra months based on the cycle. So based on the cycle, if the stock belongs to January cycle, then July is the first month of the third quarter. So after June, we look for the first month of the next quarter. So the next quarter, we say, okay, next quarter coming up is July starting. So, and July is the first month, so you will see July, and then the first month of the next quarter. So first month of the fourth quarter is October. So you would see May, June, July, and October. So this is for standard options. So there's nothing different. Plus 2 extra. So January 2022 will be listed, and January 2023 will be listed. So you will see 6 options, minimum 6 options for the lead. So this is the way you can tell this is the this stock has lead option. Now what happens after the May expiry? So let's say it was listed, the current is May date and May expired. So again, we apply the formula, which is current month plus subsequent month plus 2 extra month, plus we need at least 2 January. So how? So after the May expiry, June, which was the subsequent month before, become the current month. And July was the first month of the third quarter, become the subsequent month. So July becomes the subsequent month, right? So we have June as the current month and July as the subsequent month. Now, October was already listed here, first month of first quarter. So it's fine, first month of fourth quarter. January 2022 was also listed here as a leap. So it's fine, first month of the first quarter. So we have June, July, October, and January. June, July, October, and January. And we also had January 2023 listed. So it's there. But we need one more January. So 2 January. So January 2024 will be added. So when the May expires, then we get another January 2024. So knowing this, when the May options are expiring and you are interested in leave, then you will know that I can buy as far as January of 2024. Sometimes you decide, okay, do I buy 6-month option, 1 year options, or 2 year or 3 year? So now you know you can go as far as January 2024 when the May option expires. And just do some Googling. You need to do some Googling and find out what is available there. So June is the current month, July is the subsequent month after the May expiry, October is the first month of fourth quarter. January is the first month of the first quarter. It's already listed here. January of 2023 is already listed here. So when the month May expires, January 2024 will be added. So this is the formula for leap. Now there's another example I give you to understand. The more examples you go through, the more understanding. And you can always listen to the recording on YouTube. So you don't need to write anything, or you just listen again. So option expiration cycle. This time the option expiration cycle is March. So this is stopped. It's assigned to March expiration. Current date is May 2021. So same date. So May 2021 is the current month. June, the formula is current month plus subsequent month. So June is the subsequent month. We need 2 more months. So we say which 2 months we need. So we say, oh, okay, so the stock is assigned to the March, and March is the 3rd month of the quarter. So we need 2 months of the 3rd quarter. So we say, okay, because June is already there. So September is the 3rd month of the 3rd quarter, and December is the 3rd month of the 4th quarter. So September and December are there. So this is the standard formula, current month, subsequent month, and 2 extra months. Now, because this stock has leap option, so and we need two January beyond beyond these 4 months, we need 2 more January. So January 2022 is there, and January 2023 is there. So now we have 6 months. But what happened when the May expire? So in this case, when the May expiry comes, and it belongs to March, May expiry coming and it belongs to March. So what happened here? June becomes the current month, right? So June was the subsequent month, now becomes the current month, because we need a subsequent month. So subsequent month after June is July. So this is added. July 2021 is added as subsequent month. September 2021 was there, so it's here. December 2021 was there, so it's there. And then we have 2 January 2022 and January 2023. So you see, in this, for this stock, the leap month not added. So this stock, the leap month is not added. There's 1 month added in between, which is July 2021 after the May expiry. So our formula is current month, subsequent month, 2 extra month, and 2 leap year options, January. So this is the example of March expiration cycle for leap. So yeah, that's it. I made it very short. So now let me go back and tell you what you learned today, and then I'll go back and explain quickly what you learned. So we learned about option expiration. What is option expiration cycle, right? There are 3 types of cycles: January, February, and March. And each stock is assigned to one of these option expiration cycles. And then there is a formula: current month plus subsequent month plus 2 extra months. So we remember that. We know what happened after the options, the current month expires, and what happens, how the month is added. We know that. We also know for the leap. So leap has January options, long term. So leap. So now all that, I go back and explain to you quickly once more. So we have 3 types of option: weekly, monthly, and quarterly. Weekly options start on Thursday, expires on Friday. It's for hedging and balancing, etc. Trading around the news, earnings, and some unexpected event about to occur, etc. So you're not sure, so you're just buying just enough time. And then you know also that if you are in the option and you want to roll over, you get a new weekly on Thursday, and which expires next Friday. So it's easy to transition from one week to another week. So that's the advantage. The monthly option, the last trading day of the 3rd week, not the last Friday, the last trading day of the 3rd week. So if the Friday is a long weekend day, then options will expire on Thursday. And legally they are settled, exercised, or assigned on Saturday. Now the quarterly option we talk about is for big boys. So just make sure what you're doing. You will see large contract sizes. So they do their rebalancing. if you can read that they're buying these many contracts on the long side or on the short side, what they are doing, whether they're hedging or speculating, etc. They rebalance their books on the last day of the quarter. So they go do all that. So you may not see some activity, you will see some large blocks and the spread is wide, and then you wonder, well, what is happening. So just be careful. Just know that they're doing it. So the March 31st is the last trading day of this quarter. So just pay attention to these DIS by IWM QQQ. Now, what is option expiration cycle? We discuss expiration dates that apply to different series of options. It applies to stocks and index options. So the formula is, just remember the formula, current month plus subsequent month, and then 2 extra months. So the 2 extra months are based on the formula, depending on which option expiration cycle the stock is assigned. So there's a January cycle, February cycle, and March cycle. So January is the first month of the quarter, February is the second month, and March is the third month. So that's all we need. If we know this, if it's February is the second month of the quarter, then the 2 extra months will be the second month of the third quarter, or the second quarter, or the fourth quarter. So stock A can be assigned to January cycle, February cycle, stock B, and stock C can be assigned to the March cycle. And the formula we discussed is January is the first month of the year. So April is the first month of the second quarter, July is the first month of the third quarter, and October is the first month of the fourth quarter if the stock is assigned to January cycle. Same for February, second month is the February. So May, August, and November are the second month of each quarter. The third month, if the March is the expiration cycle, so March, June, September, December. These are the third month of the second quarter, and the third quarter, fourth quarter, etc. And the formula is current month plus subsequent month plus 2 extra months. So it's for speculation and hedging. That's why they introduce you the extra month of the subsequent month. So transition from one month to another month. Ease of trading. More ways to trade, more ways to be creative. So option expiration cycle example I gave you, if today is January 1st and it so happened that this stock belongs to January cycle, then the 4 months will be January, February, and then April, the first month, and July. So we talk about that. Another example I gave you, if it's a option expiration cycle is January and February is the current month, then we will have February, and expiry of January will create another month of March, because it's a subsequent month of February. After February is March, and it has April and July because it belongs to January cycle. So first month of the second quarter, first month of the third quarter. And same way, when February expires, then March is there already, April is subsequent is there, July is already there, and then they add another month, which is October, and October is the first month of the fourth quarter, because this stock will happen, it belongs to the January cycle. So then we talk about leap. Leap not only have 4 months, but the January month. So January 22, January 23, this stock belongs to January cycle. The current date is May. So we will have May, June, July, October, and January 22, January 2023. And then we need to know what happens when the current month expires. So which month will be added? So if the May expires, then we have June, July, October. So we have 3 months already here, June, July, October here, June, July, October. And then we also have January 2022 because it says a January cycle. So it's fine. So we are left over with January 2023. So then they add another year, January 2024. So we know that. Another example I gave you is if the option expiration cycle is March. So if option expiration cycle is March and current date is May, then we have, after the May expiry, we will have June as a current month. July will be added as a layer, another one. And September, December was already there. January 2022 was there, and January 2023 was there. So this month is added right after June. So instead of January, a month got added. So knowing these will help us in trading. So that's it for today. And we'll cover more topics on such more topic like stock dividend, cash dividend, and trading systems, etc. So I'll let you know via email. All right. So thank you.